Okay, welcome back, traders. It's been a wild week in the markets. It's April 26th, Friday, 2024. So let's get into the market. So again, a reminder, this is an educational video by Ranking LLC. And just quickly, if anybody is still interested in Ranking Insights, you want to get on the mailing list, just send an email to support@rankinginsights.com. I'd appreciate that. In our agenda, we're going to go over the indices. Then, of course, we're going to get into the market breadth under the surface to see what's happening. And then we're going to have a pretty good segment on shakeouts. Talk a little bit about what I look for and what they're telling us right now. And then we'll wrap it up. So let's get into the indices. This is the NASDAQ composite at about 3:15 Eastern time today. So just to get the perspective, we've come down about 7.9%, almost 8%. Things were not looking good a week ago. And then this week has been kind of volatile. We had this bounce that we had, and then we came back sharply. On Thursday, we really had an expectation breaker with the news about the Meta after hours earnings reaction. It could have been very reasonable to think we were going to tank lower, and the market fooled us again and gave us an expectation breaker where the market gapped down and then actually pushed higher, and gave us a few clues that maybe there was some buying that was taking place, renewed in tech. And then we also had after hours, like we had Microsoft and Google reporting. And so we had a gap up, and you can see this purple line on my chart is actually the 20-day. Looks like we're trying to, this is day 5 of a rally attempt off the low. We're trying to close above the 20 EMA. I'm not sure at the timing of this video, we've just about market close. But is this a follow through day? Well, the volume looks really, really light unless there's a surge here in the last part of the day. The volume looks light. Also, if we can get above the 20, that's a good first step, but we still have a red line here, which is the 50-day simple moving average above. So we have the 50-day above us, and I've just drawn this kind of dotted line, which is picking up some of the lows that we had in late February and early March, and kind of creating a little zone sandwiched between the two, which could be a little bit of resistance. Who knows? We might get rejected and actually move lower. Or if we can push through both of them with some volume, it might give us a clue that the correction might be ending. Now on the NASDAQ, things are still not healthy on the net new highs, net new lows. You can see we're still at net new lows above 50. So that is definitely not positive. That's not lining up well. Maybe we're seeing the beginning of a trend change, but I'd be very, very open-minded that this could continue or this could flop over and we have another leg down. So looking at the S&P, similar, we had about a 5.9% decline. You can see we had this little rally for a few days. We had the expectation breaker day on Thursday. A couple of differences are we are having some net new highs on the S&P. Not a lot, really not that great, but at least it's green. And you can see, again, we're sandwiched between, if we close above the 20 in purple, we still have the 50-day above us as possibly a lid. So let's see how this plays out. It's not a time to be super aggressive, but I think we need to be open to put on some positions, at least maybe a few pilots. So looking at sector breadth in a different way, this is from Charles Schwab. This is looking at the S&P sector indexes. And you can see here, this chart is showing the percentage of those indexes that are above their 50-day moving average. And this is going back going back a bit. So as of April, you can see here, energy had 91% of its members above its 50-day, utilities had 100% above the 50-day, and consumer staples also at 63%. And with the correction, as you might imagine, we've been showing the deterioration. The Qs only had 26%, infotech 11%. So this is how the rotation among sectors was over the past 2 to 3 weeks. Now, interestingly enough, with the rally that we've had in the past 2 days, these sectors did not perform well today. XLE is down, XLU is down, XLP is down. And with the rally, we've got XLY, the discretionary is up 1.36%, communications up over 4%, and the Qs were up over 1.8%, approximately 1.8%. So some of the sectors that were rebounding are showing good performance today, but they're still coming from some pretty oversold levels. Now, excuse me. Now, looking at the XLE a little deeper, this comes from JC Perrett over at All Star Charts. Great chart. This is showing the weighting of the energy index in the S&P. And you can see long-term chart. Way back in 1991, the XLE was about almost 16% of the weighting in the S&P. By the tech dot-com bubble days in 1999, it was only 5% weighting. 2008, it got back up to 16. 2020 and COVID, the XLE was only 2% of the weighting. And you can see today we're at 1.9% weighting in the S&P. Now, it's really small. There's been not a lot of interest in commodities, even though they've been performing fairly well the past 6 to 8 weeks. It is possible that there's kind of a catch-up trade here with XLE continuing to gather some weighting in the S&P. Even if it got up to 5, 6, 7%, that could be a significant move in the XLE. So it's something to keep an eye on. I know a lot of people are not following the commodities as deeply as growth stocks, but we want to just be aware where the money's flowing. So this is a chart from Carson Investment Research. It's an interesting chart. What it's showing is when the S&P comes out of the gate very strong in an election year, and they show here, the chart is showing 5 years, 1956, 64, 72, 76, and 2012. When we come out of the gate quick with the S&P, what did it do the rest of the year when you were in an election year? And you can see here that the blue line is 2024, really good correlation with the composite. Now, fair to say this is not a big sample size, but it is what it is. But generally what it shows is after the big start, there's generally a correction for 2 to 3 months. And you can see we've had a correction, which is actually much sharper than the combined 5 years prior. So correction possibly for 2 or 3 months. Then it shows that we could get a rally over the summer, maybe June, July, and August. We get a 2 or 3 month rally. And then the rest of the year was basically flat into the election. From September all the way out to the end of the year was generally flat. So I don't want to put too much emphasis on seasonality and some of these correlations. It's not a big sample size, but it is interesting that for the first 4 months of the year, we were pretty well correlated with this. So something to keep in the back of your mind. So let's get into, I guess it's education, talking about shakeouts. And how do you know if a stock is being accumulated and it's simply a shakeout, or if the stock is really being distributed and you should get out? So I put out a video on June 9th, 2023. So go through my YouTube, go to June 9th. You'll see the video called Shakeout or Get Out, where I go into some of this. But I'm going to give you kind of a cram course in this video here. The first slide is really about, I'll tell you, the anatomy of a shakeout. And what a shakeout really is accumulation done by the institutions. So as an example to demonstrate this, if we have an institution Y and they want to own 225,000 shares of a stock, but they're worried, they don't want to push the price up too high beyond, in this case, $48. So how does an institution do that? And I've drawn this kind of theoretical chart down here, a little chart pattern showing, the chart shows support at the lower end at 45 and resistance up around 55. And as I mentioned, this institution already has a position at 48. So how does an institution, accumulate a lot more stock and not push the price higher? So here we are. This is 48 on the chart. Now, what institutions will do is they will tend to manipulate the crowd, the retail investors. So they know that when a stock is in a range, it's getting support at 45, resistance at 55. So they know that many retail traders will put their stops just below the lows of the range. So you end up with a lot of different orders being placed at $44.90, $44.50. So you get all these orders. So these are all probably a lot of retail small orders. And let's assume that when you aggregate all those orders, it's 100,000 shares that is sitting below the market. So what does an institution do to achieve their objective? Well, an institution would do this. An institution has the power to move the market. The institution would sell 125,000 shares in order to push the price down and break the stock. By pushing the price down and breaking the stock, as you can imagine, all these little stop orders of retail traders are getting ticked off, and they're all become market orders. So what happens as the stock is falling is this institution, after that block of stock pushes things down, starts to buy. They start buying all the stock that has been triggered. And as they buy all the stock that's been triggered, and they start buying more at a lower price below 45, don't forget, when the stock breaks 45, short sellers start to short the stock, thinking the stock is going much lower. So as the institution buys all of these orders and takes all this stock, plus they keep buying, they actually force all these stops to be hit. And as the stock comes rising back up, all the short sellers now are forced to cover their short positions, which creates even more buying. The shorts have to buy, and this institution is buying, and you'll see the sharp recovery. And in that sharp recovery, that is what creates the shakeout. There's a sharp move down, and then just another sharp move right back up. So in this example, just like magic, the institution now has 225,000 shares, and they did it below $48 a share because they got all these shares below 45, and then they bought more shares, probably between 42 and 48. So all of a sudden, they now have their position without moving the stock above 48. It's kind of interesting when you take some of the mystery out of a shakeout, but that's mechanically kind of what's happening. So what do we look for in shakeouts? Because we're trying to determine, ultimately, we're trying to say, when this stock breaks, is it an institution that's trying to shake out people because they're accumulating stock? Or is the institution breaking the stock because they're running for the exits and there's distribution going on? So two scenarios. One is the shakeout with the V shape, and the V shape is very important in a shakeout, and you want to see the V. So here's an example of a stock that was moving sideways. Here's the shakeout, comes down sharply, breaks the red line, which is the 50-day moving average, and you can see immediately comes back strong and recovers the original buy point. That's a shakeout. That's the V action that we like to see, and the fact that it kept moving higher confirms that it was a shakeout. What we don't want to see is a stock that comes down hard, comes back up to the prior pivot zone, and then kind of rolls back. As soon as it starts rolling back, you need to get out. It's not a shakeout, and this was probably distribution. So this will make a little more sense as we look at some examples. So on the left is Rambus. This is from April of 2023. Stock is right here, formed a little consolidation, and then you can see a sharp move lower, actually breaks through the red line, which is the 50-day. And then you can see this V. There's the V, comes right back. Now, the stock comes back strong, and what's really a clue that maybe it is a shakeout is the shakeout. You can see the volume here, but look at the recovery volume. It dwarfs the shakeout volume. So that's that surge of buying of people that were shorting the stock and the institution buying back their position. Came back very strong. You could have made a bit of aggressive buy probably in here, or you could have waited for the original pivot to be recovered, and you could have bought back up in here. But that's an example of a real V-shaped shakeout. Now, on the right side is shift for payments for, again, April of 2023. So again, we have a stock that was in a range. You can see the low end of the range here. We break sharply lower. There's a lot of selling in the stock, and you can see this huge volume day. Now this stock closed mid-range, doesn't look too bad, but you can see the rally attempt up kind of stalls out. It tries to get going again. It runs into the 50-day, and the stock starts to roll back. The V is not completed. We don't get back up to the pivot level up here. As soon as it starts to roll back, we want to get out. because this is really distribution, not accumulation, as we saw in the Rambus example. And you can also look, there was really no buying volume on the recovery. So that's a good template to look at something rolling back, and you probably should get out of the stock. So other things that I look for in shakeout candidates, I look for institutional quality names that have good liquidity. Are the names that you're looking at, are they early in their move, or is it very, very late in their move? Because you're trying to understand or trying to sort out, is this accumulation still going on in the stock because it's early in the move, or is it very late stage and maybe the stock is under distribution? Sometimes the relative strength line on that pullback can be a clue as well, how strong the stock is and how the volume comes in as well. So looking at the mechanics, the 50-day simple moving average is really commonly used as an area that institutions know that retail traders like us, we use the 50-day. We use the 10-week, the 50-day. They know that if they can break it, there's probably a lot of stop orders there if they want to get more stock. So I have found over the years that institutions will push things further below the 50-day before they start accumulating stock back. I use the 65 exponential moving average as a guide of where I've seen stocks get support on shakeouts. Now, there's nothing magical about 65 exponential moving averages. Some people use the 68 EMA, some use the 78 EMA. You have to find what works for you, but I'm going to show you a series of examples. We're going to look at 6, and I'm going to show you the 65-day that I typically use. So here is Vertiv, and these are all real-time shakeouts. As I mentioned on Monday and Tuesday, it looked like we were seeing some shakeouts develop. So Vertiv has been one of the strongest stocks in the market, was moving sideways, and you can see here's the break. We had a little bit of support in here, and you can see the red line. We break below that. The red line is the 50, and here's the blue line, which is the 65 EMA. You can see the stock didn't quite get down to the 65 EMA, but the stock breaks, and then you can see here's the V, starts to come back up. And this stock actually, we had a wild week with volatility. It recovered the original pivot, which is very positive, but it kind of stalled. So that was a question mark. Then we had yesterday where things came down and it got back above the pivot, and look at the recovery volume. Big blue volume on the recovery for 1-2 days. So that was very positive to try to really give us a clue saying, this is probably a shakeout. They stole some shares down here from retail because they still want to accumulate the stock. And this is the bar today around 3 o'clock this afternoon that's showing it's still staying above the pivot. So probably is a shakeout. Now here's MedPace Holdings on the right. Again, here is the kind of support level of the range. And then we get this sharp break down to the 65 EMA. And actually we get this very wild day where we actually came all the way down and then reversed back up. It's interesting that if you put the high volume close from the earnings gap up day here, it kind of got down to there before it found some support. But it came back strong in a wild day. You can see this is the recovery point that we're looking for. So this stock actually got up above the recovery point, but then it rolled back. It failed and stalled out and it rolled back. That would be a signal to me to cut the trade. It's not a shakeout. The stock is not ready to be accumulated in any big form. So I would be very, very cautious on that situation and probably dump the stock. Now, when we're looking at shakeouts, it's important. They're not exact. It's tough to gauge. Is it being accumulated or distributed? And I'm just sharing what I use. Now, even if you have a failed shakeout, I want to emphasize that doesn't mean the stock is complete toast and is never going to work. It just might mean that the stock needs to form a much more full base. So this stock over here might form a base. So don't completely give up on a stock that fails at a shakeout. I'd keep it on your watch list if it has good characteristics. Here's another one. This is Toll Brothers from the home building group. And again, stock was getting some support in this level here by this black line. And then we had the sell-off in the market. And you can see the stock broke below the red line, the 50-day, and came all the way down, actually undercut the blue 50-day line, pretty sharp in 5 days in a row. And then you can see here's the shakeout. We come back up strong. We got some good volume on this day, but then yesterday or on Tuesday or Wednesday, it was stalling out. Didn't look too good here because it looked like it was going to roll back. Got very, very questionable. But then today we've had a little bit of a push higher. So I'd say it's so far so good, and only because it's above the 20. We'll have to see how it plays out. This could continue and confirm it's a shakeout, or if it starts to roll, then you want to get out. Qualcomm, again, another strong stock that was moving sideways. You can see here a little base, and then we have these lows. And these lows, all of a sudden, we have this dramatic sell-off, undercuts the 65-day, but you can see how it's starting to come back. You know, it's really running into some resistance, though, because it's right up into the 20-day EMA and the 50-day simple moving average. So this one is really the jury's out. Low volume on the recovery. So that's not clear to us yet if this is going to roll over, or is this stock going to keep pushing higher to confirm the accumulation. So it's hard to read. Day by day, you have to look at these. Two more and we'll wrap up. This is Celestica. Again, a strong stock that's been performing well this year. Again, was going sideways in the base, and I've kind of drawn a red line here of some support areas. And then you can see the sharp shakeout, boom, down to the 65. We undercut the 65-day, and we had a nice sharp recovery, but you can see it stalled into the 20 and the 50. Then it tried to go again, stalled again at the 20 and the 50, and it stalled a third time. And today it looks like it's rolling back. So if you played the shakeout and bought in here somewhere, I would be getting out of the stock if it's rolling back like this and cut the loss very short. So that one doesn't look so good. And then we look at NVIDIA, which is really the granddaddy of this market in terms of tech. Again, we had the stock moving sideways after a major move up again. And then you can see here, this is the shakeout forming. We get this surge lower. You can see the distribution on this day here, which was a very bad day. It was down almost, I think, 10% last Friday. And then the stock has tried to come back. We had yesterday's wild action. And then today it's continued to push up, looking like it probably is a shakeout, particularly in a leading stock that was under a lot of accumulation. So I'd say it looks okay. I actually took this trade in here, but the one caveat I have in my mind when looking at the chart is this day right here. This was the big earnings day. Excuse me, not the big earnings day, but the day where it had a reversal, a sharp reversal in here and had a high volume close. Very, very large volume as it ran into $1,000 price level. And if I take that low and I draw that line across, you can see that the stock is running right into it. So it definitely lets me frame the trade, though, because if this were to roll over in the next couple of days, that tells me that it's really not a shakeout. But if it motors through on Monday and Tuesday and really comes back strong, then it might be a place to add to the position that I started this morning. So you got to be very, very flexible and see how it develops. So let's move on to some watch list names. It's a good time to have your watch list. So here's a series of stocks that are on my watch list. These are stocks that are in bases or very close to breaking out. Got Wing, A-Lab, Coin. Any of these stocks that are on my watch list here, make sure you check the earnings date. They're coming up fairly soon on some of these names, so you might not be able to position yourself before earnings. Shakeouts, there's a lot of them that are potentially out there that could be playing out. I've gone over a good 6 or 7 of these. You might want to really monitor these. But again, the whole game is trying to understand if the stock is really shaking out and being accumulated, or it really is under distribution and you should avoid it. Pullbacks to the 10-week. Here's a series of names that I'm kind of looking at. Robinhood, Shake Shack, PWR. And relative strength names. These are great names because they didn't pull back that much with the correction. Coupang, you got Spotify, Transmedics, and Chipotle, which I have a position in, is moving higher on its earnings report. So high relative strength names. Should definitely be on your watch list to see if you can find an entry point. So let's summarize. Let's see where we are. So where are we relative to trend? Well, we had a correction at 6% for the S&P, 8% on the NASDAQ. We don't know if it's completely over. We don't know if we're going to roll again or if we're going to move ourselves higher. Complete the support levels in the chart. We're below the key moving averages right now. The 20-day is key. There's no power trend in play right now. We're just trying to get those closes above the 20, and it looks like both indexes will close above the 20, but they still have below the 50-day, and in some cases, charts show a declining 50-day. New highs, new lows. This is not as strong as I'd like to see it. If the market is truly going to resume an uptrend, I really want to see at least 3-4 days of S&P and the NASDAQ hitting net new highs. The NASDAQ has been really very weak in that area. Leading stocks, we're watching bases. We've just spent quite a bit of time looking at shakeouts to try and give us the tone of the market. Exposure levels, I do think, the action where we had the expectation breaker day allows us to put your toe in the water. You might take 10 to 15% of your portfolio and buy a couple of pilots. Doesn't look like we got a follow through day today. Doesn't mean we can't have one on Monday. Looks like volume might have been light today. So it's a tough environment right now. So be very careful out there. There's no reason to put capital to work if you don't see good setups and we don't see the market conditions improving. So the quote of the week is a Japanese proverb. Everything must wait its turn. Peach blossoms for the 2nd month and chrysanthemums for the 9th month. So this is all, to me, this can be interpreted a lot of different ways. I look at it as patience. There's a time that you should be aggressive in the market, and there's a time to be very defensive in the market. It's been a challenging environment the last 2 months. Wait for your right pitch. We want a fat pitch when the odds are on our side so we can all make some good money. So with that, that's all the time I have for now. It's Friday, April 26, 2024. Wonderful weekend to everybody, and we'll see you all here next week.